One company lost more money last year than most nations spend on their entire space program, and its stock still hit an all-time high the same week. That's not a typo. That's not investors losing their minds. That's the strangest bet in modern business history, and you're about to understand exactly why it's happening. Here's the question nobody in finance can fully agree on right now. Why are the biggest AI companies on Earth spending more money than they've ever spent on chips, on data centers, on electricity, while some of their AI products barely break even or lose money outright? And why does Wall Street keep rewarding them for it? If this were any other industry, that combination would be a red flag. Massive spending, thin margins, no clear profit timeline. That usually ends careers. Instead, it's minting some of the highest valuations in corporate history. So today, we're going to break down exactly where this money is going, why the people running these companies think it's worth it, and why smart, skeptical analysts are split right down the middle on whether this is genius or the most expensive bet ever placed. The spending. Let's start with where the money actually goes, because the numbers alone are hard to process. We're talking about spending on data centers the size of small towns. Custom AI chips ordered years in advance, sometimes before the factories that make them are even finished. Long-term energy contracts. Some companies are now securing power output equivalent to entire cities just to keep servers running. This is capital expenditure, CapEx, on a scale that used to be reserved for national infrastructure projects. Reports suggest combined annual AI infrastructure spending among the largest tech companies now reaches into the hundreds of billions of dollars, and that number keeps climbing every single quarter. Here's the part that trips people up. A huge portion of this spending happens before there's a proven mass market way to make that money back. They're not spending based on current profits. They're spending based on a bet about the future. But here's what nobody's talking about. This isn't the first time an industry has done this, and history might be the key to understanding what's really going on. The bet. Think back to the railroads in the 1800s, or the build-out of the electrical grid, or even the early internet fiber-optic boom. In every one of those cases, companies spent staggering, seemingly irrational amounts of money building infrastructure before anyone knew exactly how it would be monetized. Many of those companies failed, but the infrastructure they built became the foundation everything else was built on top of. That's the argument AI companies and the investors backing them are making right now. This isn't spending for today's revenue. It's a land grab for tomorrow's compute. Whoever controls the most powerful, most efficient AI infrastructure controls the platform everyone else has to build on. And once companies and consumers are locked into an ecosystem, switching becomes expensive and inconvenient. That's called a moat. And moats are incredibly hard to cross once they're dug. There's also a first mover psychology at play. If you believe AI will reshape nearly every industry, then being even 6 months behind the frontier could mean permanent disadvantage. In that mindset, overspending isn't reckless. Underspending is the real risk, okay? So it sounds like a smart long-term bet. But wait, it gets stranger. Because not everyone buying into these stocks actually believes that story. The debate. Here's where the split happens. On one side, you have investors who genuinely believe in the long-term platform argument, they're willing to wait years, even a decade, for this spending to convert into dominant, high-margin businesses. On the other side, some analysts point to a disconnect. The revenue currently being generated by AI products doesn't yet come close to justifying the capital being poured into building them. Some question whether demand will actually scale fast enough to match the infrastructure being built. Others simply argue that in a market this excited, momentum itself becomes the reason prices go up, regardless of underlying fundamentals. Neither side has been proven right yet. That's the uncomfortable truth here. This isn't a solved debate, it's a live one, playing out in real time, one earnings report at a time. And that's exactly why this story matters more than almost anything else happening in markets right now. Because the outcome will shape entire economies, not just tech stock prices. So where does that leave us? Some see today's AI spending as the electrical grid moment of our generation. Expensive, painful, but foundational. Others see a gap between promise and proof that hasn't closed yet. Maybe the honest answer is, we won't know who's right for years, but the bet has already been placed, and it's the biggest one corporate history has ever seen. So here's the question I'll leave you with. If you were running one of these companies, would you keep spending, or would you pump the brakes? Drop your answer in the comments. I read everyone.